Hello, welcome back to class, and we'll be looking at the advanced consolidation and corporate restructuring. Advanced consolidation and corporate restructuring. And for this, we will look at accounting for associates and joint ventures, equity methods of accounting, step acquisition and disposal. We'll also look at the changes in ownership interest, the foreign subsidiaries and currency translation and group reorganization. This is what we will look into in the module, and we are creating a brief understanding into this module. This module builds on the consolidation principle from module 8, and it covers complex scenarios such as investment without control, changes in ownership, foreign operations, and group organization. And key standards when we are talking about this include IAS 28, IFRS 11, IAS 21, and relevant sections of IFRS 10 and IFRS 3. Let's look at associate and joint arrangements under this module. An associate is an entity over which an investor has significant influence, typically 20% or more of voting power. And when we talk about the joint arrangement under IFRS 11, this is actually classified as joint operation and joint venture. For joint operation, it means parties have rights to assets and obligations for liability, and for joint ventures, parties have rights to net assets accounted for using the equity method. For the equity method of accounting, it's actually used for investment in associates and joint venture, and the investment is initially recognized at cost and adjusted for. The investment share of profit or loss, the investment is initially recognized at cost and adjusted for 1. The investment share of profit and loss, and 2. Dividends received, which reduce the investment's carrying amount. And fair value adjustment and implicit goodwill are included in the carrying amount. Let's look at step acquisition and disposal. A step acquisition occurs when control is achieved through multiple purchases, and previously held interests are measured to fair value upon obtaining control. And loss of control triggers the recognition of subsidiaries' assets and liability, recognition of any retained interest at fair value, and gain or loss on disposal recognized in the profit or loss. Looking into the changes in ownership without loss of control, when ownership changes but control is retained, it's actually when ownership changes but control is retained, and this includes buying or selling of shares to or from the NCI. It includes buying of and selling of shares to or from NCI, and the transaction is treated as an equity transaction, and no gain or loss is recognized in profit or loss. And lastly, the difference between the consideration and the change in NCI is adjusted directly in the parent's equity. For the foreign subsidiaries and currency translation, each entity must determine the functional currency based on its primary economic environment. And for the translation, which is under IAS 21, asset and liability are translated at the closing rates, and income and expenditure use transaction date rates or average rates. And lastly, exchange difference are recognized in other comprehensive income. For group reorganization, this is a common restructuring which includes the hive up and hive down, and the demerger and common control transactions. And transactions between entity under common control are accounted for as carrying amounts and not in fair value, and no goodwill is recognized in common control transfer. For non-monetary exchange and complex structure, under non-monetary exchange of subsidiaries between group are measured at fair value unless lacking commercial substances. And for complex group structure, it requires careful tracking of direct, indirect, and mixed holdings, and uniform accounting policy and consistent reporting dates are essential for accurate validation under this. In conclusion, advanced consolidation topics are essential for handling real-world corporate complexity and having a mastery of equity accounting, foreign currency translation, step acquisition, and reorganization is critical for transparent financial reporting. And these principles ensure consolidated statements faithfully represents the group financial position across jurisdiction and ownership changes.